Hey guys, this is Nick from Financially Aware, and in this video I want to talk about the banks reporting their earnings and Wells Fargo reporting a loss, cutting their dividends to shore up their loan loss reserves. And I'm going to talk about the loan loss reserves and what that says about what the banks think about the economy in general and real estate in particular. So banks use loan loss reserves because they have to put aside money in case some of their loans go bad, which they always do. And in the good times, their loan loss reserves are small, like here. But in the bad times, like in the financial crisis, they have to keep increasing them to the point where during the financial crisis, they got as high as maybe 6% of their outstanding loans. And right now, they're more of the range of about 2% of their outstanding loans. So they may need to shore up their loans by a lot more before this is over. Now, in the good times, they reduce their loan loss reserves and add it to their earnings to goose their earnings. But in the bad times, they take that money from their earnings, or from, in this case, Wells Fargo, their earnings that they would have paid to their dividends, and add it to their loan loss reserves, like here. Now, to give you an idea of how unemployment is tied to commercial bank loan delinquency rates, look at this chart. The red line is the loan delinquency rate and the blue line is the unemployment rate. So they match very nicely. And you see here in the financial crisis, it spiked way higher than the unemployment rate. And now, we're just at this point here where the unemployment rate has spiked, but the commercial bank loan delinquency has not spiked to its peak by any means. So all the banks are expecting that this is going to get worse in the future. So because of this, this is why the loan loss provisions of these banks, JP Morgan, Wells Fargo, and Citi, some of the biggest ones, have spiked tremendously in the last 2 quarters compared to just the last quarter of 2019 or the last couple of years. And again here, the financial crisis, it's already spiking to those levels and above in some instances of where they were on their loan provisions during the financial crisis. And so this is, even from the words of the bank CEOs, they think this is kind of just the beginning. They're not seeing any peak yet. So they're expecting things to get a lot worse before they get better. So this is a look at the Wells Fargo allowance for credit losses for loans. And this is the first quarter of 2020. This is the second quarter. And you see the most, the most problematic loans are the real estate mortgage and real estate construction. And so as a percentage of all the loans, their allowance for credit losses in the first quarter for real estate mortgage was 0.69%. Now in the second quarter, it's jumped up to 1.93%. So close to 3 times more than just 1 quarter ago because of the delinquency in payments that they're seeing. Likewise, real estate construction was only 0.17% in the first quarter. Now it's 2.23%. So they jumped up from 36 million in loan loss provisions to 484 million. And for the real estate mortgage, from 848 million to almost 2.4 billion. And on the whole, their loan loss provisions was 1.19% in the first quarter on about $1 trillion in loans and credit. And in the second quarter, now it's 2.19%. And that $1 trillion has come down a little bit to 935 billion. But still, it's, almost double the loan loss provisions from 1 quarter to another. That's a huge jump. And if you break out these 2 categories, real estate mortgage and real estate construction, by their components, you have this chart here: office buildings, apartments, industrial warehouse, retail, excluding shopping centers, etc. And you see that their non-accrual loans of 1.3 billion is up 286 million, or 30% since the last quarter. Non-accrual loans means loans that haven't made a payment in 3 months, 90 days or more. And 59% of those loans that haven't made a payment in 90 days or more were shopping centers, retail, and hotel motels. And 90% of the increase in non-accrual loans was from shopping center, hotel, motel, and retail non-accruals. Also, their criticized assets of 10.4 billion, up 6.1 billion, or 140% since the last quarter. Criticized assets means doubtful assets, assets that they don't expect payment on, or that they maybe expect that they're going to go bad. So just over 1 quarter, it's up 140%. So again, these these numbers are pretty big jumps, and this is just the beginning, because the effect of the shutdown has been muted by the PPP and the loans to businesses and all of that, and the stimulus package and everything. So once that stuff runs out, then you're going to see the real deal of who could pay and who can't. And the CEO of JP Morgan, Jamie Dimon, said savings are up, incomes are up, home prices are up. What he means by that is the savings are up because of the stimulus. There's a huge amount of savings in the banks now because of the stimulus, and also because people couldn't go out to spend, so their credit card debt has been decreased, or they paid it up a little bit and they weren't spending as much. But he says you will see the effect of this recession. You're just not going to see it right away. And he says, we are prepared for the worst case. We simply don't know. I don't think anybody knows. And here you see that Wells Fargo cut their dividend from 51 cents a quarter down to 10 cents a quarter per share. That's an 80% drop. Their dividend was, I believe, one of the highest, or if not the highest, bank stock dividend at 8.4% before this per year. Now it's down to 1.6% a year. So that's a huge drop, and a lot of people who may have bought this stock for the huge dividend are going to be probably either selling it or thinking about selling it or reconsidering, because there's probably a lot better stocks out there with more safe dividends. And just to look at the stock price, this is the S&P 500 on a monthly chart. So you see from the bottom in March, it's gone straight up. Coincidentally, it's yielding 1.8%. So you can buy the whole S&P 500 and now yield better than Wells Fargo, which has not been doing very good since 2020. You see that it's over 50% off of its high, and now this 8.4% dividend yield is gone, and it's 1.6 or so. And in this article on Zero Hedge about the biblical default wave and the avalanche of bankruptcies, here's a bunch of bankruptcies that have already happened. Brooks Brothers, Chesapeake, LATAM Airlines, Hertz, JCPenney, Frontier, Whiting Petroleum, and others. But the thing is that Gold's Gym and things like this, a lot of these companies that are going bankrupt, like a Gold's Gym or something like that, who's going to take up that real estate? Or these GNCs in the mall and all this stuff, who's going to take up the slack in that real estate? If those buildings don't get filled, then those mortgages don't get paid to the Wells Fargos and the JP Morgans and the Citigroups. And so that becomes more bad loans, and eventually those buildings are not going to be able to support the mortgages on them, and they will either go back to the lenders or get sold for lower prices. So that's where this all comes together, and it's bad news for the real estate market, commercial real estate at first. But again, if all these people are out of work and all these companies are going out of business, putting more people out of work, then eventually that will trickle down to residential real estate as well. So not a good time, I think, in the next year or so for commercial real estate or even residential eventually. Now this takes some time to go through the system. By the time people lose their jobs, stop paying their mortgage, get notices from the bank, go to court, get foreclosed on and all that stuff, it takes a while. So you may not see these prices drop very quickly, but if the unemployment rate stays high, it's inevitable. So that's my video on the banks and the real estate market and what's going to happen in the future from what it looks like, as long as unemployment stays as high as it does. If you like this video, give me a thumbs up and let me know if you think the real estate market is going to come down, and if it's only going to be the commercial real estate market like retail and malls and hotels, or if it's also going to include residential real estate eventually if the jobs don't come back. As always, please subscribe to my channel if you haven't done so you don't miss any of my new videos. Thanks for watching.